Ladies and gentlemen, the best possible news could have just taken place from that SoFi fireside chat earlier this morning, or at least that's at the time that I'm recording this video. So, what ended up happening was that Chris Lapointe, their CFO, just reaffirmed that they are aiming between 55 to 80 cents of EPS. Regardless of what's happening in the macro, they are not changing their long term guidance. And it's not even that long term, it's just a few years from now. So, assuming the fact that we are going to essentially get between 8 to 9 cents of EPS this year to grow all the way to potentially 80 cents by the end of 2026 is a massive feat going in just a couple years, okay? Data driven investing, another friend of the channel, also wanted to talk on this as well because he wrote an article talking about what could potentially happen getting between now and the end of 2026 whenever we're reaffirming guidance that is so much higher, right? So he wrote this article. I want to go through with you guys. It's an extremely long article, so we'll do our best to make it as digestible as possible. But yeah, this is his article. Please check him out. He's got a Substack that you can check out right there. But SoFi going from 0 to 60 cents of EPS. Great, great, great title. But let's read some of this, and I'll give you some of my thoughts. So first, he says SoFi stock has been really weak, even as the S&P 500 and other indexes see all-time highs. Sentiment in the investor community is absolutely near all-time lows. All right. I might be playing a small part in this. I've been bearish on certain aspects of SoFi while also holding the stock. Haven't sold a share in my entire investing career of SoFi, meaning, of course, I've sold shares of other businesses. But anyway, so they are reaffirming between 55 to 80 cents of EPS in 2026, earnings per share. Okay. So why do we care? SoFi is in a transitionary period right now. They're going from a period of unprofitability with hypergrowth in revenue, like 50% over the past 5 years, to one with lower top line revenue. Top line revenue, that's kind of like saying the same thing. Anyway, of 25%, but profitability on cash flow, EBITDA, GAAP, net income basis. So if they end up hitting those targets, we'll be trading around a 2026 forward PE of 10x. Okay. For a company that will be growing their earnings so rapidly over the next several years, that'll be an extremely cheap valuation if this guidance is correct. The highest estimates, however, from Wall Street is actually only 61 cents. So, which is actually below the midpoint for SoFi's guidance. You can see some of their estimates here, what they suspect. The average analyst is actually only anticipating for 2026 44 cents. You have 7 different analysts that are bringing that target to 44 cents. So you have some saying 61, and then others actually betting below 44 cents, which is below SoFi's lowest GAAP EPS target. Then also, we'll go over the revenue, but to go further on, I'll let Chris Hager do some of that talking. So he's talking about why he's doing a projection. There's always going to be error in any model that we do, but it's giving us an important framework of the different range of outcomes and factors that could be important if you are going to potentially be investing in this company or playing options with this company. Whatever you're doing, you want to know what is possible with the company and then what's the likelihood of success in those outcomes. So he did 3 separate scenarios. Okay. He's doing a base case scenario, which is essentially just going off of SoFi's guidance. He's doing a bearish scenario and then a very bullish scenario, assuming some outperformance of what SoFi has said. He'll talk about why he's doing that as well. But he, instead of just 2026, he's also going to take that out to 2028. Let me do another zoom. So he's going to cover this based on a couple factors. So one is segment level growth. Okay, so that's going to go between lending, technology platform, and financial services, the 3 big segments of SoFi's company. So that's going to assume lending to be around 90, or actually, let me skip this for a sec because he's going to just tell you what the base case is. I'm assuming the lending segment will be 93.5% of 2023's revenue. The tech platform sees 20% growth, and financial services sees 75% growth this year. So that is exactly what SoFi's management is also seeing. So that's going to assume about a 15% CAGR between 2023 to 2026. He thinks that lending is going to reaccelerate to 26% in 2025 and 26. Tech platform is going to accelerate to 27.7%. And financial services might cool from 75% to 45% in 2025, 33% in 2026. Overall, hitting that 50% compounded annual growth rate, which was part of their guidance. So, best way to see it right here, that lending, he's going from anywhere from negative 10% all the way to, plus 30% in 2025, trailing off into, 20% growths in the most bullish side. But you'll see here, he even points this out as being the part that is by far the most drastic, from negative 4% to 26%. For people that understand the lending platform, this actually isn't really that crazy. It's not that they don't have the ability to grow loans. They just said it in the fireside chat. They're declining 80% of their lending applications because they want to be more conservative. So the day that they do not want to be more conservative, they can ramp this business drastically, so much faster than what they currently are doing. So absolutely, that's going to be the case, or could be the case. I don't want to say going to be the case. What is potentially more, hard for someone like myself to believe is this tech platform growth, seeing 28% or 30% growths. I truly hope for this to happen. It's just historically, this has not been the case. It's hard for me to wrap my brain around the idea of consistent 30% growth rates year after year after year. It's definitely in the realm of possibility, but a lot of things will have to go right. Okay. Next, let's look at contribution margin. Subtracting out all the attributable expenses for each of those three segments. He shows off the current margins all the way to Q1 of 2024 for at the top here, lending platform, and then the technology platform below it. He's going to go into financial services a little bit deeper. But yeah, so technology platform hovering in and around this 30% mark, and lending hovering just around this 60+% mark. Now, financial services is largely a fixed cost business, which means that as you grow revenue, you don't need to grow expenses very much. I love this chart that he did. It's such a great way to visualize just how fixed these costs actually are. So as these directly attributable costs have gone up, right around Q3 of 2022, you're starting to get within this bracket that it has not left since. But during that time, you can look at, Q3 2022, the amount of money that they brought in, somewhere about $50 million. Today, they're bringing in $150 million, but the directly attributable expenses has barely climbed, which means they went from being extremely negative. Anytime that this blue bar is below this orange bar, that you're taking on losses for that, for that business. In the last 3 quarters, we saw a little bit of an increase. I think it was about $3 million into $18 million into like $27 million, something like this. I don't have the numbers in front of me, but it is consistently growing now, which is very, very exciting. Now, he breaks it down even further. Since that Q3 of 2022, for every $100 in revenue that they've brought in, $88 have gone to straight profits. That is leveraging with scale. So as this scales out, I wonder if it's going to be very similar to Nubank, where you see that their cost to serve a user is like 90 cents, but the average revenue per user has just gone one direction. That would be an amazing sight to see for SoFi going forward. And then this is their margin as well. Breaking through that profitability and continuing to climb upward. Love it. So in the contribution margin assumptions, you can see right here, very great as well. He's going anywhere from a lending of 60% all the way to 69% margins. You're not going to see many decreases, or if any decreases. He's not assuming macro changes. He's not going to assume things that he can't necessarily predict. There are a couple easy predictable factors that SoFi over time is going to look back at their processes and try to make them more efficient, more cost cutting, better margin businesses. That's across the entire stock market. So he's going to assume better improving margins. It's just whether or not they actually hit it. 42% margin on tech platform. It's a possibility. The only problem is that they are going to continuously put in new money to try to find new growths, right? So there's going to be, although fixed costs can stay fixed, that doesn't necessarily mean that you're not going to add on new fixed costs to try to make that growth rate happen even faster. Then he goes into other expenses. Love it. Now, this is things like brand marketing with, SoFi Stadium, the TGL Golf League, NBA deal. We are the bank of, or the official bank of the NBA. Management compensation, a lot of other general administrative costs, stock-based compensation, depreciation, amortization, all that great stuff. And this is what he has shown throughout this time. So the orange bar is the growth rates. The blue bar is the actual expenses. Okay. He goes on to say that Q1 of 2024 was actually the first time ever that they decreased these other expenses from one quarter to the next. I mean, I didn't look deeper than just his chart, but it definitely looks like this has decreased quarter over quarter, and this has decreased quarter over quarter. I don't know if I'm looking at that wrong. But yes, it is on the up and up. The business is growing, so obviously your expenses are going to grow too. This is not Google. We don't have 95% margins here. So there will be more expenses. He's going to take the bet that it's going to increase about 10% every year for the next 5 years as just an overall easy assumption. But he also put in here, this is probably most likely the largest miss that he's going to have in his assumptions. So let's go through the cases. Bearish case, easily the best one to look at. Because it puts everyone on their toes and makes people a little jittery. Let's do it. Revenue. Not far off from analyst expectations, which is absolutely hilarious. He's going to assume that the entire business grows at 9% in 2024, 23% in 2025, and 18% in 2026. Now, on EPS, or actually, I can just open this. This will be much better to look at. Okay. Bear revenue, what you can see from 2025 to 28, about $2.25 billion to $4 billion in 2028. EPS actually being extremely negative in 2024, 8 cents or negative 8 cents. They're expecting 8 cents this year, but this is not actually Chris doing anything other than taking the segment level growths that he has applied and applying it to the contribution margins, and then also factoring in those other expenses, right? So this is what those numbers are showing off. These aren't like just random guesstimations. Remember, oops, sorry. Yeah, let's just move on. You get the point, but he said, he's probably wrong on the negative EPS in 2024, assuming underperformance in the next 3 quarters. Probably not going to happen. Anyway, base case. This is the one that corresponds to SoFi's guidance. It includes no product launches throughout 2026 and assumes no meaningful changes in the macro environment. SoFi is also assuming a 5% unemployment and negative GDP growth at the end of the year. There's been some debate. I remember seeing an article that said that they actually anticipated 2.5% or negative 2.5% GDP growth. But then looking back on it, no one could find that article again, even though it was in everyone's heads. I thought it was going to be in a transcript. If anyone knows exactly where that comment came from, please let me know. I did want to read this quote right here, though, where he says that he believes that the only way that they underperform this guide is essentially a hard landing or a recession, which, aside from that they think that they could hit this very easily. Remember, there's 3 main risks to SoFi, okay? You have interest rates, unemployment, but most importantly, competition. Interest rates and unemployment is going to fluctuate over time. Competition is going to be that risk that is always there. He brings up the idea that SoFi, if macro doesn't change, that they are definitely going to hit 75% growth rates in financial services or something like this. That doesn't necessarily mean that that's going to happen. Those are future assumptions, although there are they come out of the mouths of people who have the most information. They don't have the key to what's going to happen into the future. We pray that SoFi is going to be the products that people want into the future, but that doesn't necessarily mean that that's going to be the case. So, revenue is going to assume a 16.4% growth in 2024, followed by 15.2% in 2025 and 19.6% growth in 2026. It's actually funny. It's extremely close to SoFi's guidance, but if SoFi gets even close to 2026 top line guidance, it represents a significant upside to analyst estimates. He also, based on, so this is not just management's guides, it's based on his, segment growth and contribution margins and everything. The results are saying that SoFi's EPS will go to 31 cents in 2025 and then doubling again to 64 cents in 2026. Let's just take a look. Why is that chart so small? Let's bring it up. Okay. So here he has the bear case, which we've taken a look at, which is the first two lines here. And then the second one is the base case, which is the one that we're reviewing now. EPS still very low, 6 cents, 31 cents for 2025, 64 cents for 2026, 88 cents for 27, and $1.15 for 28. So just to show you guys, this is almost exactly what my predictions are for SoFi. I have 10 cents of EPS for 2024. I think it's 33 cents for 25, 68 cents for 26, 86 cents for 27, and then $1.03 for 28. I do think that there will be some topping out, but we'll have to see. Now, let's get into the fun stuff. Bullish case, okay? Always sandbagging, and they always perform. That's SoFi's motto, right? They've done this for 3 straight years. Let's take a look. So this is exactly where revenue has come in, is this blue line, and that orange line is what they were telling investors was going to be what they're expecting to see. So they've always beaten it. Even whenever this line has gotten close right here, it still end up being larger than what they've expected. They said on average, their guidance beats by 22 million each quarter. So that's very good part from Chris. Thank you for adding that in. Adjusted EBITDA, very same thing. They beat their adjusted EBITDA guidance by 19 million each quarter. Love it. Even when it gets close, that blue line is still just, can I get really close? It is still above. All right. So lots of fun there as well. The actual results then would probably be somewhere closer to the bullish assumptions that I gave above. Okay, so what he's saying is, although SoFi has given base case revenue, he actually believes it's probably going to be higher than their overall assumptions. Let's take a look. So the bullish case would result in 21.3% growth in 2024 for revenue, 40.1% growth in 2025, and a 33.1% growth in 2026. For an overall 3-year compounded annual growth rate of 31.3%. In this scenario, SoFi will have revenue of $3.5 billion in 25 and 4.7 billion in 2026. If we get $4.7 billion in 2026, I don't know what I'll do. I'll do something crazy. I'll jump in something crazier than a pool, though. That's a callback to a SoFi Weekly where I bet wrong and had to jump in a pool with all my clothes on. But once again, few new product launches and a favorable macro of slowly dropping interest rates, and we could definitely see this in the realm of possibility. EPS. My bullish scenario results in 93 cents of EPS in 2026. We just got to see it. Let's just pop this thing open. What he shows is the analyst projections, which only go out to 2026. There are some analysts that'll go all the way out to 2028, but it's like one. Okay, so you're not really getting a range. You're only getting one person's assumptions. Anyway, looking at the bull case, much higher in 2024 for revenue, and EPS for the bull estimate is actually in line with what SoFi is expecting this year. And then it just gets absolutely crazy. 50 cents in 2025, almost $1 in 26, $1.40, $1.95. I mean, I'll be a very happy camper if that happens. We're probably not going to add somewhere between 40 to 50 new cents of EPS every single year going forward. Be quite drastic. I hope it happens. I hope. But yeah. Said a picture is worth 1,000 words. So let's just throw this into graphical form. You get to just see, look at where these analyst projections are for revenue, just hugging that bear case. The base case, which is what SoFi is more closely, projecting, and then what could actually happen if everything is in SoFi's favor. So they are just absolutely bringing all that pessimism. I don't know if you can even see blue. If you guys are colorblind, you might think that there's only one line there, but no, that this little line right here is analyst projections. That blue, it does exist. Freaking crazy. And then EPS, same thing. Let's go ahead, take a look at these projections. Bear, analysts, base case, which is guidance, and then that bull case. Crazy. Analysts are simultaneously assuming that SoFi won't grow as quickly as they plan, seeing here how close it is to the bear case. But then on EPS, it's actually much higher. So they actually think that they're going to have stellar margins. It's freaking nuts. It like he said, the more likely explanation is that they just don't fully understand the business. I love it. Okay, SoFi 70-30 rule. This is the idea that management has always said that they want to reinvest 70 cents of every incremental dollar back into the business and drop 30 cents to the bottom line. Okay. Their incremental margins will be 30% during the growth phase of the business, but they've also recently said that they want to have their net income margin hovering about 20%. Said the base case that I've outlined above would show that there's been a 37% incremental margin through 2026, which is slightly higher than the 30% that they're guiding for. It results in an overall net margin of 17.5% in 2026 and 23.6% by 2028, which also seems fairly reasonable and in line with long-term guidance. Here, he graphs that out for you guys. Love it, love it, love it. So how does SoFi go from 0 to 60? SoFi must stay in line with long-term contribution margin guidelines for at least low to mid 60s for lending, mid 30s for tech platform, and around 30 for financial services. Might be high, who knows? There will need to be a real reacceleration in revenue in 2025 and 26 of around 30% year-over-year growth. This is part that appears that analysts do not believe will happen. Absolutely. They think that this is a company that's going to continue to grow in the teens. And they need to stay disciplined with other costs, allowing them to only increase about 10% per year. So this is what all the assumptions are coming with. So he said, I would not be surprised to see them entering into small to mid-sized banking for checking, savings, lending in 2024. And I'd be disappointed if they didn't launch those products in the latest in 2025. They're making strides in wealth management segments and have the opportunity for SoFi at Work products to actually make inroads with huge companies in that space. They could also expand the credit card platform. I didn't highlight these because they're much longer term, but like things like insurance or geographical expansion are also on the roadmap as well. If Galileo can also start to become a credit card issuer and processor and expand into other verticals, that would also be a great addition to the tech platform offering. Now, I love this. Chris and I are very much aligned here. He's not looking to do price targets. This is not just trying to like pump stock, but he does want to project out the fundamentals. It's a great thought process. It's good to do with your positions. Once again, I don't know why this thing isn't huge, but then data-driven investing does want to give you his own beliefs. So I also quoted them out. I wish he gave year-over-year guidance, but for 2023, this is not part of his assumption, but a part of what actually did happen. We saw 33.15% growth. He sees about another 18% growth in 2024, 35% growth in 2025, and then 33% growth in 2026, bringing up 2026 revenue to 4.4 billion and EPS of 85 cents. So not only between that 55 to 80 cent EPS, he actually thinks they're going to beat it. I actually think they're going to come right in line, right in the midpoint, 68 cents in 2026. But hey, we'll both be laughing. Whether it hits 68 cents or 85 cents, it'll be a glorious investment. His just will be better. And yeah, massive multiples between here and going forward. Every year previously, we've been negative on EPS, so it's really hard to gauge where growth has been versus where it's going. Um, but that is some people's alpha if they think that this is going to be, a stock for them. So, ladies and gentlemen, that's the video. Hopefully, you guys liked it. Thank you, Data Driven Investing, for giving us this great breakdown. There's some amazing charts in there. And make sure you guys go check him out. Follow him on Substack, follow him on X. But until next time, thank you so much for watching, and bye for now.